Hello, we are getting ready. We're almost there. Just waiting for a few people to pop in here. We didn't have time for the usual thumbnail and announcement that comes out about 2 o'clock of going live, what we're going to talk about. But that's just the way the last few days have been. It's been a busy time. This is the busiest end of summer I have ever had in my life. Well, I should say in my working years. How about that? Let's get ready to roll in 3, 2, 1. Here I am. Hey, thanks so much for joining me. My name is Mitch Goldberg. You're watching my live stream. It's called Be the Boss of Your Money. It's all about putting the personal into personal finance. Personal finance truly is personal. That's what we talk about on the show. We talk about investing, the stock market, investor psychology, behavioral psychology. We talk about a lot of things, but money is such a complex issue, and it is so connected to human error, emotion, biases that we need to put things in perspective. I'll just share with you a couple of anecdotal things with some clients today, go over what's going on in the market, the economy, the reflation trade, the economy back on opening. That continues to rock and roll, except the stocks had a major pounding the last few months. So they haven't moved up all the way yet compared to where they were a few months ago. So that's what's going on today. Bank stocks were the standout performer of the day. And we'll talk about bank stocks as well. So let's just roll a quick intro. And what else do I want to say? Sometimes when you are doing a live stream, it's not like there's always so much time to research and look at things. I like to run and gun. I like to just turn on the cameras, get into it. What's going on? I am very comfortable doing that. Most people aren't. I know that, but I don't mind. So sometimes you have to pivot. Pivot. All right. Let's roll the intro, and we've got a super good show. Super good. Jolly good show. Here we go. Okay, we are back giving you the behind the scenes, over the shoulder view. All the gear to go live is here. I know I definitely make it more of a complicated affair, but I'm having fun. I love doing this. You've got my all my gear over here and the gear over here. And let's go over here. It's interesting. Hold on a second. Hold on. It's not that interesting. There. I forgot to put on one of my lights, and I want to see how it looks with the light. That's a little better. You could see that a little bit better. I have what's called a hair light. It's beaming down on me, and the idea is it lights up your it lights up your top of your head and your shoulders to give you some separation from the background. I enjoy the technical aspects of going live as much as I do the content. If you haven't noticed. So we're going to go through the market, but let's talk about. So let me start again. So let's talk about putting the personal into personal finance. I was speaking with a client the other day, as I do every day, but someone I also consider a good friend, and he said, it's too bad I went more conservative. It's too bad I didn't have more in the market. Look how much more money I would have. And you have to understand, this is somebody who is investing based on, his family's time horizon, financial goals. And this is somebody in his late 50s, wants to retire in the next year or two. And he can definitely retire in style. And His concern was after the market rallied at the end of 2020 that, things have come back. I'm worried about the economy. I'm still worried about a lot of things, just a jumble of worries. I want to retire. And it was at the point where, this is someone who wanted to pull back on risks. A lot of money in the market for this individual. Plus, this individual works for a publicly traded company. So there's even more stock exposure. And what we had decided to do is move some of the assets into more of a 60% stock, 40% bonds and cash portfolio, because that was what was appropriate for him. And the conversation went something like this. If the stock market keeps going, you're still in it, but there's a compromise here, because you'll always feel like you didn't have enough invested when it goes up. When it goes down, you'll always feel like you had too much invested, but it's a compromise, and that's what we have to do. And he's cool with it, and he's great. Everything is fine. But I said to him, "What's the difference? How much more money you could have made? The goal for you is never to maximize returns at all costs, at all risk. The goal was to make a decision based on your personal finance, not on how high the stock market is, or how much higher the stock market could go, or if the stock market could go down, have a big 50% drop and take a very long time to recover, if at all. I know the stock market has always recovered after every bear market. I get that. But you have to understand, when you're talking about somebody's money, somebody's financial and emotional and psychological well-being, these things are part of the conversation. And what I said to him is, you can't look back and beat yourself up, because it doesn't do you any good. It was based on your personal finance. We went through our plan. You've got enough to achieve what you want to do, and then some. Still have plenty in the market and other assets, real estate. And now it's time to think in terms of your financial obligations coming up in the next few years, and that you need to have, we need more than your standard 3 to 6 months of cash in the bank for an emergency. And that's what I always want to make decisions based on someone's time horizon, not, oh, maybe we should get out of the market because it's too high, or maybe we should scale back on risk because the market's too high. Now, I do scale back on risks in clients' accounts, but it's because they are well out of a boundary of, let's say someone was 80% stock and 20% bonds, and now they're 90 or 95% stock. Yeah, I want to cut that back because I am outside of the boundaries of acceptable risk parameters from the client. Now, I don't just automatically scale back stocks because stocks go up a little bit. You do have to give them a chance to run. But you have to have the conversation with the client, say, based on everything we're doing, you're way out of boundaries. It's time to rebalance, recalibrate, and maybe not get all the way back to 80% stock, but at least maybe 85% stock. And sometimes the clients realize that, hey, you're older and maybe we need to be 75 or 60% stock. And the point of that is, I'm making this asset allocation modeling decisions based on everybody's individual personal finance. Everyone has their own glide path in life. This is why I don't just subscribe to age-based or target date portfolios. It's one thing to do this inside of a 529 plan, but I'm talking when it comes to somebody's retirement accounts, their joint account, their taxable accounts, etc. Everyone has their own life cycle pace that they go through. And more or less, I do know what your next life cycle will be, because you're probably not that different than everyone else. Okay. I know we all like to think we're unique, and you're always told you're special or you're unique, and you are totally special and unique. But life's circumstances and situations are more or less the same for people. Save, invest, retire, sell your primary family home, buy another home, maybe buy a vacation home. You want to travel. I know what's coming up for you. And that's the beauty of working with, by the way, with a financial advisor who has experience, because they take all those experiences, they take the challenges that have been met, the failures that have had to be corrected, course corrections, and we take all of that and we apply it to your situation. And every time we work with a client, we become stronger for you, and that benefits you. I can't overstate the benefit of an experienced financial advisor working for you. All right, so there's my sales pitch for the industry. Let's take a look at how the market did today. We'll do a quick share screen. I'll pop myself up in the corner. Okay, so the Dow, the S&P, the NASDAQ, they were all up very modestly. They continue their rally that started late last week. Markets all touched record highs. The averages touched record highs. So we're in pretty good shape. Now, underneath the averages, there are lots of stocks that have done well. There are lots of stocks that have done poorly. So just looking at the averages doesn't always tell you exactly what has worked and what hasn't worked. So gold continues to stay a little under 1,800. Oil rebound a little bit back up to 68. I think we need to see oil over $70 and stay there for a while to get excited about energy stocks. The VIX, I always talk about the VIX, and 20 is the demarcation. That's the line, the zone. Okay. We go above 20 in the VIX, stocks go down. We go, above 20, stocks go down. We go below 20 and stay there, stocks go up. And that's what you're saying. It's really tough to find what could throw the market for a loop right now. So let's talk about the main thing. The main thing is coming up this weekend. Did you know that the Jackson Hole Economic Symposium starts on Thursday? It starts tomorrow. And that's in Wyoming. And Jerome Powell, chairman of the Federal Reserve, is going to be speaking on Friday. He's giving the keynote address. And in that, he's expected to outline the Fed's plans to taper. Now, the Fed has been talking about tapering so much and so often that investors become almost like inoculated against it. And that was the point, to beat us over our head constantly, nonstop, about the Fed's taper, so that when it finally comes around, we're prepared for it, we're positioned for it. And that's why you saw some volatility over the last 2 or 3 months. That's a big part of it. Obviously, the Delta variant is a very big part of it as well. But there's been a lot of volatility because investors are getting ready for the Fed to start reining in its stimulus. That was my post today on social media, by the way. If you follow me, I'm on Instagram at InstaMitchG, LinkedIn, Mitchell Goldberg, AIF. You'll find me there. So connect with me on LinkedIn and Instagram. My Facebook page is Client First Strategy, and my YouTube channel is also Client First Strategy. Please subscribe if you check out the YouTube channel. So, as we expect the Fed to pull back on stimulus, a lot of people are worried, well, that might be it for the economy because the whole market's up on stimulus. The whole market is not up on stimulus. There have been buybacks. Operating leverage is the highest it's ever been for corporate America. There are other things. The major averages, in particular, the S&P 500, which is an index, and you can't invest directly into an index, but you could invest in a security that tracks or mimics an index. I say that so many times. It's like I say it in my sleep. I wake up in the morning. It's an index. You can't invest directly in an index. Ugh. So the thing that I'm trying to say is that the index is very influenced more than ever by technology, that the S&P 500. And technology is an incredible earnings / cash generating sector. So as technology dominates more of the S&P 500, it makes the S&P 500, I don't want to say bulletproof, but it makes the underlying, the index just such a strong, powerful force. I don't know why I'm banging my fist against the table and I say strong, powerful force. All right. Yeah. So that's why it's hard to find something that could knock the market for a loop. But we're talking about the taper. The Fed buys bonds every month, pumps liquidity into the market. And now the Fed's expected to start pulling back on that liquidity. And I've been saying for a long time, I don't think the economy needs all of that stimulus. If you have any questions while you're watching this, whether if you're watching in the live or in replay, certainly hit me up in the comments with your questions. Words of appreciation, words of wisdom, words of encouragement are always appreciated here. And we've got Bill. Hey, hello, Bill. So nice to see you. Thank you, sir, very much. I appreciate you hanging out with me for a little bit. Bill, we've got to meet one of these days just to shoot the breeze and get a cup of coffee. Man, it's like we've met before, but it's been a long time since we all saw each other in person. All right, so let's go on here. We've got I know Bill is out there. Josh is out there. Thank you, Josh. I really appreciate it. You're a good friend. So that's the only thing that I could see knocking the market down is if the taper is maybe faster than we expected. But we all know about the taper. The Fed buys $120 billion worth of bonds, and the Fed wants to go down to maybe $110 billion and $100 billion. But it'll take about 10 months to be done with the taper till they are at zero buying bonds back. And then they'll talk about raising interest rates. And by the time they get to raising interest rates, the Federal Reserve will have talked about that so many times, so often that you'll be like, I can't wait till they finally raise interest rates already. I'm so sick of hearing about the first interest rate hike since since whatever year, since 2018. That's actually what it'll be, the first one. Jerome Powell raised rates 3 times in the end of 2018. The stock market in the fourth quarter of 2018 went down about 19.99%. So some people call it a correction. Some people say it didn't quite hit 20, so it doesn't count. But that was the last time the Fed raised rates. They're not expected to raise rates till maybe very late 2022 or early 2023. So we've got a while for that. If the economy is doing well, earnings are doing well, interest rates should be higher. So don't say, if they raise rates, it's all over. If interest rates reflect a good, happy reality, and they're up for that, that's not a terrible thing. Inflation, if we get that, it just means people just pull back on spending altogether, and that's bad for the economy because it lowers economic activity and it changes the plans of consumers and businesses. And what they start doing is they start buying things now because they feel like if I don't buy now, I'll have to pay more later. And that becomes a self-fulfilling frenzy. Just like with deflation or extremely low inflation, everybody says, well, why should I buy anything now when I could get it cheaper in a couple of months? You see how that works? It's psychology, such a big deal. That's how we started the show. Let's just take a quick look at the watch list while I've got you here. Okay. It's something we do every day. So let me go to the watch list. No need for you to watch the screen. I'm going to pop this up here in a second. Okay. I put myself up in the screen. Okay. Here I am in the corner there. So Deere up $8. United Rentals is about as, economically sensitive as you get. American Airlines, GE, Oshkosh. I'm not talking about the children's clothing maker. Oshkosh makes cement trucks and fire engines, big, giant, heavy things on wheels. Okay. Textron, Grainger, man, oh man, Grainger has been such a home run. Caterpillar. But let's take a look at the other stuff. Let's take a look at the sector ETFs, financials, energy, industrials, and building materials. See this XLF? These are the 11 sectors that represent the 11 sectors of the economy. Each one of these exchange traded funds is a sector fund. So XLF is the financial services sector, XLE is energy, XLI is industrials, XLB is building materials. You see that? And the four most sensitive ones to the economy are up the most. That's a positive sign. Investors feel bullish. That's a very short-term indicator, but I see a trend emerging, and financials are almost back to their all-time high, just a couple of pennies away. Energy's got a ways to go. Industrials are almost there. Building materials are not far. What was at the bottom? The stuff that you would buy when you're worried about the economy slowing down: healthcare and consumer staples and technology. So that's the story today. All right. I appreciate you watching. My expectation is we'll get the word of the taper on Friday. The COVID news, it's still really bad, but it's not as bad as it was. Hospitalizations, people going on ventilators, and deaths are actually lagging indicators. I'm not making light of that. I'm just saying that the rate of increase of infections is already starting to go down in this country. And as we see that, it just revitalizes the opening trade. And this is why, by the way, you see a certain group of stocks that has been going up, and I've been showing you these. All right, the reopening stocks. Let's just pop this up here while I have you. Okay, look, Marriott Hotels, Royal Caribbean, Southwest Airlines, UAL, Norwegian Cruise. They're all up, every one of them that I follow. Planet Fitness. So this is where we are. Don't make crazy mistakes. Don't make crazy trades and reconfigure your portfolio for the long term every time you hear about an economic shutdown, then an economic reopening. You're just probably making yourself lag in terms of earning returns that you should be earning. And I want you to have a portfolio that you could stick with. I always say, what good is a portfolio if you can't stick with it? I guess really I always ask that, not say it, but a portfolio that you could stick with that has less risk, less volatility, will do better for you than a high return portfolio that has a lot of risk if you can't stick with that. If you keep selling when times get bad and then buying everything back when things feel better, and then selling again when things get bad, because you wind up, buying high and selling low over and over again, where you should just buy and, work a little bit, but mostly hold, rebalance a little bit. Okay. Monitor and make changes accordingly. All right. That's it. I will see you tomorrow, and it's great to see all of you. Have a great night.